All right, thanks, Tom and Jeff. My name is Matthew Lemieux. I'm a senior research analyst, and as was mentioned before, we're going to kind of look through the first quarter when it comes to flows basis. Again, just as a reminder, these numbers are considered preliminary, and we say that just because we haven't gotten all of our March month-end assets in, but I think we've got a pretty good picture on what we've seen this quarter, and as Tom alluded to, really the story's been to equity funds. So let's kind of just jump into it. So at first, when we just talk about the overall numbers, the headline numbers are good. We're talking about over 170 or close to 170 billion in net inflows, 118 into mutual funds, and about 50.4 into ETFs. And we had pretty good numbers last quarter if you joined us, but a lot of the inflows for mutual funds was really supported by strong buying for money market funds. So let's just click it a couple of times here. And let's take a first look at mutual funds. If you kind of been following us over the last couple of quarters, you could recognize that this chart does look quite different, specifically on the left-hand side when you're looking at U.S. diversified equity and sector equity. So let's focus on that. $22.1 billion of net inflows into U.S. diversified equity. Now, this is a really stark comparison to what we saw fourth quarter of last year, where we saw about $28 billion going out. This is the largest first quarter, again, preliminary numbers, $22.1 billion since about Q2 09, when we saw about $25 billion coming in here. And really, who can blame the market? I mean, again, I think as Tom mentioned, people looked back at 2012 and thought they really kind of missed the boat and really kind of came rushing back into the market. I think that there was generally some better views on the economy as opposed to what we've seen in previous periods. And at 10.16% on average for Q1 equity returns for U.S. diversified equity returns, it seemed like it was the right bet at that time. Sector equity, 13.4. Again, a good comparison to quite a different story than last quarter. We saw about 3.7 out. And then world equity, $54.8 billion. A lot of buying globally, and we'll talk a little bit more of that, really heavily supported by emerging markets. Last quarter, about $2 billion. So a lot of money going into that group. But then again, taxable fixed income, $55.5 billion. At the beginning of the year when we first started, saw the general shift into equity funds. A lot of analysts out there were, I think, a little quick to diagnose the market as possibly a great rotation out of bonds back into equity. We know that equity has been out of favor for some time. But really the numbers overall, yes, we've seen strong flows into equity, but investors are still continuing to be lenders. They continue to buy fixed income, 55.5 this quarter. If you look at Muni, 9.5. But again, money market funds, a big difference from last quarter. Last quarter, I think we saw about 143 billion of inflows as people were ending out the year, showing a little concern that we had talked about previously. Now they really wanted to put that money to risk, $98.5 billion coming out of money markets back into riskier products. And then again, going back to Tom's, 61.2 billion into mixed asset. This is going to also include variables as well as our preliminary March number, so a little bit higher than what we said before. But that's really a big area we like to focus on because there are a lot of new assets, new sales going into mixed asset products. So if we click it again here, we'll see the comparison to ETFs. Again, similar story, and in general over the previous quarters we've seen ETFs, especially on the equity side, really doing well while mutual funds have struggled. But they've really kind of struggled to keep pace because investors, especially on the retail side, when we look at mutual funds, we kind of use that as the indicator for the retail investor as opposed to the ETF space, because we know there's a lot of institutional moves there. But either way, U.S. diversified equity about 19.4 in, sector equity 8.6. World equity 15.8 and fixed income 5.7. So ETF buying really continues to be strong as well, and we'll kind of get into those numbers as we go to the next slide here. Click it again. So usually, I kind of just select some of the largest ETFs out there to kind of see what the market's doing. This quarter, I was a little bit more selective on kind of the story that I wanted to tell on how we kind of saw big moves in the ETF space. So if we click the first one, we're going to be looking at SPY. As we've seen before, SPY, a lot of volatility. We really look at it as being used heavily by institutions on making bets on the broader market. If you looked at last quarter, we saw about $8.7 billion to end out the year, as a lot of investors were really parking their money into beta products, maybe with some of the concerns they felt just buying the market and letting it sit was probably the best idea. But this quarter, we really saw quite a bit of selling, $9.3 billion on the aggregate, which was somewhat surprising for a lot of people. Specifically, we've seen that the market's done so well. So, it kind of tells us maybe a couple things. Is one, throughout the quarter, investors were just paring back some of their gains, just taking some profits off the table. Or, in fact, maybe some of the institutions were really tired of taking that passive money and putting it to work elsewhere in actively strategies, putting more risk on. So, $9.3 billion SPY. And again, it was kind of interesting because the next group we'll look at is IVV, which is the iShares S&P Core 500 group. And they actually saw $1.9 billion. So again, that really kind of more supports the story we've seen, where investors feel more comfortable this quarter about buying U.S. diversified equity, specifically exposure to the S&P 500. So the next group we're going to talk about is the EEM, which is the emerging markets product. This at the beginning of the year, really we saw continued buying into emerging markets. Emerging markets has really kind of been one of those bulletproof groups when it comes to flows for some time now. Regardless of performance, regardless of concerns, we've continued to see net positive flows into the emerging market broader group as investors really try to diversify their portfolios and position themselves into that perceived future growth area. And again, that seemed to be kind of the story at the beginning of the quarter, until we hit really kind of late February, when we started hearing concerns about specifically Cyprus. And you can kind of see the dynamic from there. At least from the ETF side, investors really kind of felt that maybe that was the point to kind of sell a little bit, take a little bit off the table of that risk and go somewhere else. The next one we're going to talk about is DXJ. When we're talking about Japan, the biggest product out there for the ETF side is EWJ, iShares Japan ETF, and that's the largest, about $7.2 billion. And it had a strong quarter, I'll point out, about $1.3 billion. But when you look at DXJ, which is Wisdom's Tree Japan Hedged Equity, it had about $3.9 billion in this quarter. And it really was some savvy investors understanding what was kind of going on in Japan with the depreciation of the yen, as well as the positive outlook for their equity market. And really what they were looking for is a product that would help hedge out that depreciating yen so they could get basically pure exposure to the equities. And really it paid off, because not only was there $3.9 billion going into this group, but if you look at the performance in the first quarter of DXJ, they brought in about 16.8% return during the first quarter, as compared to if you looked at just your standard EWJ, which had about 10.8%. So investors really looking to Japan, understanding that if the yen continues to depreciate, that might cut into their earnings. And again, this product at the beginning of the year had roughly about $1.2 billion in it. At the end of the quarter, 5.5. So a lot of investors looking at this product. Another interesting product that's really kind of been, the strategy itself has been on the radar of a lot of investors is the iShares MSCI US minimum volatility. There's a lot of interest right now in volatility minimization products. I mean, this one specifically uses volatility weighting. But again, I just wanted to bring it up, $1.4 billion so far this quarter. It started the quarter at about $768 million. Now it's about $2.6 billion in assets, so it's grown quite a bit. The next one is going to be BKLN, which is PowerShares Senior Loan. As Jeff had mentioned, a lot of interest into what we call the loan par or bank loan section. $1.5 billion, basically doubling its assets within the year. And then the last one is GLD, gold. Spider Gold, we know that gold really struggled, down about 4.78% for the quarter. And investors really kind of turning away from that allocation, $6.6 billion out of that product. Roughly, if we look at the ETF, the US ETF space right now, we're seeing about $1.45 trillion in assets. So it's continuing to grow, and I think it will continue going forward. So let's look at the gainers and losers from the equity mutual fund side. A lot of the similar names we've seen in the past on both the top and bottom, but for U.S. diversified equity, we saw multi-cap core bring in about $9.3 billion for the quarter. It was also the top in Q4, and really this is going to be your broader diversified group. A lot of passive money going into here. People really just feeling good about the equity space, but they really don't want to be too specific, so they're buying the market. Equity income funds really kind of came back to the top again. We had seen it at a little bit of a lull, but $5.5 billion for this quarter. So once again, investors still feeling not only confident about the equity space, but looking for yield as well. And S&P 500 index, $4.3 billion, again, adding on to what it saw in Q4 of 2012. During that quarter, it was about $3 billion. So really diversified, and a lot, again, of passive money going into this group. So let's go over to the sector group. And again, for a real quiet area, somewhat on the performance side, we continue to see a lot of money going into this group, and it was so many interesting groups. I mean, real estate really has been a group that a lot of investors have been looking at. A lot of people feel very good and have a lot of they're very they have a good very optimistic on the real estate market, $3.7 billion going into that group for the quarter. But two of the other groups really are somewhat interesting. Commodities general, so this can be your diversified commodities, actively managed products, $3.1 billion. And as Tom had mentioned, a lot of the commodities, especially when you broke them out into the individual groups, whether it was base metals or agriculture, struggled on a performance basis. So maybe investors are really kind of setting themselves up with some active managed, want to kind of diversify themselves and get into commodities, or maybe feel that if in fact the economy globally starts to get better, commodities will eventually turn around and go that direction. And then again, natural resources, $1.8 billion. So two interesting groups where a lot of money was going into for the sector. Real estate, really not that surprising. The third one we're going to be looking at is world equity. This is really a lot of money going into this group. And as I mentioned before, we saw a little bit of weakness in EEM and the ETF side end of February. But overall, if you look at the mutual fund space for the quarter, some really strong inflows. Emerging market equity funds, $15.6 billion for the quarter. Right behind them, basically, was international multi-cap core at $12.4 billion. Again, this is really a group with a lot of passive money. It's a very diversified group internationally, so if investors really just kind of want to buy the market outside of the U.S., this is really where they were going, $12.4 billion. And then the last group, Global Flexible, $9.5 billion. This has been a strong group. You're talking about funds that really have a lot of flexibility in their asset allocation. Investors are kind of looking for that flexibility and hoping to pair that within some of their core parts of their portfolio. Once again, we saw about $9.5 billion. With the world equity, this has been the group. These have been the three classifications that have done quite well for some time. This is actually the same top three that we saw as Q4 2012. So let's look at the losers. The U.S. diversified equity, once again, it was really dominated by large caps specifically. Large cap growth pushed out $6.6 billion. Again, a lot of buying in equity in general, but still investors really not feeling as confident in the large cap. But Tom really kind of touched on that from a performance side, specifically with the growth and some of the concerns with IT companies. Large cap core, $3.1 billion. Out of that group. And, again, still these classifications have done quite well in performance. I think large cap core, Tom mentioned, was up 9.84%, lagging a lot of the market. But, investors really kind of feeling that they could do better elsewhere. So we saw a lot of more movements into the small mid cap range. And then again, multi-cap growth, negative $2.6 billion in outflows. So large caps continue to be out of favor. And we'll go right into the sector group. Still pretty familiar and pretty same topics as we saw on the performance side. Precious metals equity, $624 million out of that group. Again, with some from performance, I think Tom had mentioned 16.9% on average for that group, so it was understandable. Global natural resources and science and technology were also once again at the bottom as they were in Q4. Global natural resources, $536 million out, and science and technology, $396. World equity, again, large caps, international large cap value, 663 out, global large cap value 313, and then we also saw some investors moving out of LATAM or Latin American equity. I think there's been some concerns in Latin America, whether it's Brazil or Argentina, dealing with their bond issues right now, even though we have seen some strength in places like Mexico. So not a big outflow, but again, some investors on the net getting out of the Latin American space. So let's go over to the taxable bond space, and at the top of the list really is that group that Jeff had touched on, where we've seen a lot of interest so far, not only this year but towards the end of last year, and that's going to be the loan participation group. Again, we kind of also reference this as bank loans, leveraged loans, but basically you're talking about floating rate paper. $15 billion of net inflows this quarter. If you look at the aggregate net inflows for all of 2012, it was about 10.8, so we're well past that. And if we continue this pace, we could easily, it seems, surpass the all-time high so far on an annual basis for this group, which was $18.2 billion in 2010. So investors really liking the two components, I think, for this group, which is going to be a little bit of a higher yield, but also some interest rate protection or perceived interest rate protection because they are floating rate papers. So those two things have really come together, and investors have kind of been moving in droves to the loan participation group. But that said, we continue to see investors buying intermediate investment grade. Again, this is kind of your core bond group, your total return, your PIMCO total return. And then we also saw investors kind of moving into the short side of the yield curve as well. Short investment grade debt funds did quite well at 8.1, and then also multi-sector income, so flexibility. But again, as you can see, really no general sign of any great rotation out of bonds. Investors really continuing to allocate money to the fixed income space. If you look toward the bottom of the group, you know, there are some other similarities to the performance side. Triple B rated funds, investors kind of moving out of that group, and then inflation protected bond funds, $2.7 billion out, even though they had about, I think Jeff had mentioned, 35 basis points of return. I think inflation in general is muted, and there's a little bit less concern for investors to go to that space. And then the one that I thought was somewhat surprising is the very last, Lipper Ginnie Mae funds. We saw $4.8 billion. And if you look at them on a weekly basis, we actually see 19 consecutive weeks of performance. And so, you know, I talked to Jeff about this, and when you think in general that, you know, people are feeling pretty optimistic about the housing market and things in that group, it really seems to be kind of an area where the risk on play is affecting Ginnie Mae. Investors, I think a lot of them were sitting in the mortgage space, and now as they kind of move out into the higher risk spectrum, whether it's on the fixed income or equity side, they're moving out of the Ginnie Mae area. So 4.8 billion out of that group. Next, we're going to look at municipal bond funds. You know, municipal bond funds for the quarter still had some strong inflows, $9.5 billion for the quarter. That compares to 5.8 for last quarter. And again, we saw around roughly $50 billion going into this group in all of 2012. But there has been somewhat of an interesting story or a general slowdown on a month-to-month basis for investors going into this group. If you look at January, it was very strong at $7.2 billion. And I think investors really were coming off of December, where there was some selling because there were some concerns about the tax benefits and whether those were going to be changed due to policymakers' decisions. We got through the end of the year, and that was not the case. So I think some selling that happened in December, investors came back in January once they realized that things are kind of business as usual. February, again, strong, but not as strong, $2.6 billion. And then so far in March, we've seen about $295 million in net outflows. If you actually look to the end of the quarter, we've seen 5 consecutive weeks of outflows. Again, nothing too heavy or too strong. If you kind of look at the 12-week chart above, you know, it's just kind of been bouncing just below the break-even point. But this is the first time we've seen 5 consecutive weeks of outflows since August 11. In fact, I think last quarter, one of the things I highlighted is if you looked at all of 2012, we only saw 4 individual weeks of outflows. So investors feeling a little bit of concern. I think Jeff is correct that I think there's definitely still some room to move with municipals throughout the year. But again, I think some investors in general are a little bit concerned whether it's municipalities being able to fund their pension programs, or a lot of the news going around just the general struggles that some municipalities are having, and whether those are going to get worse with the sequestration issues or with some of the budget cuts that a lot of areas are looking to make. So we'll keep an eye on that group and really see if investors will come back to municipals, or maybe kind of keep their current pace, which is just below negative weekly outflows, just about even. So nothing big at this point, no general shifts away from it. The next group we're going to go to is money market funds. So overall, money market funds, if you split it up by the 3 months, again, we had mentioned that really big outflows, and they really kind of accelerated through the quarter. At the beginning of January, we saw about $4.8 billion. I think February, when investors started feeling a little bit more confident that the risk on play was maybe the right thing to do, $36 billion out. And then March so far, about $57.7. I think a lot of the outflows from March was really supported by tax planning. We know we saw for I think it was the second week of March some heavy outflows right around corporate tax deadlines. So if you look at it, we're going to split it into two different groups: taxable versus tax-exempt money market funds. If you look at the taxable, definitely the largest portion, but again, just kind of showing that acceleration of outflows throughout the quarter. The next group is probably a little bit more interesting, which is going to be institutional versus retail money market flows. And interesting just because if you look at January, January, it seemed at the onset of the year that institutions were really still maybe not on board that we were going to see the type of returns in the market and the type of interest from investors. But retail, seemed to really kind of jump in with both feet already. We saw over 20 billion of outflows for the group. But then once February hit, really consistent moves across the board. Institutional and retail really pulling money out of money market funds and once again putting it out in riskier assets elsewhere in the market. So kind of just as a quick review, we'll look at kind of the top 5 classifications and bottom 5 classifications for the quarter. When we look at the top 5, again, emerging market equity funds were really the strong group, $15.6 billion, with loan participation not really that far behind, 15.0. Absolute return funds really had a strong quarter at $13.7 billion. So it seems like asset managers are really getting some traction with their absolute return type products. Advisors are having a good time, or having a better time kind of maybe communicating that to investors on how they fit within their portfolios and how they're designed to return longer risk-adjusted, provide better risk-adjusted returns over time. Then again, international multi-cap core, a lot of people buying the market outside the U.S. and flexible portfolios, $10.6 billion. And again, this is going to be similar to our global flex, except for mostly going to be domestic focused, but it's going to be funds that have a little bit more flexibility to really play the market on both the equity and fixed income side. On the bottom, again, large caps really kind of dominated that area. Ginnie Maes were the big surprise at 4.8, I think, and inflation-protected bonds at $2.7 billion. So I think going forward, when it comes to a flow standpoint, I think there's a couple definite topics out there that are really going to be what investors are going to be watching. Q1 earnings, I think as we're getting into the earnings season, investors really kind of take a look at that. The second is employment numbers. We're really kind of just came off of some disappointing numbers for March when it came to non-farm payrolls, also higher than expected initial jobless claims. So it'll be interesting to see when we get this real first or second week of flows in the new month to see if that really kind of took some wind out of the sails of investors when it came to allocating new money. But again, I think earnings really can supplement that concern. But the last one really is, will investors continue to flock toward equity? I think that's the big question out there. We've seen quite a bit of flows so far this year, but this is really not too dissimilar from the story that we saw at the beginning of 2011, where basically within the first 5 months of the year we had about $50 billion in net inflows into equity funds, and then once again the Eurozone difficulties popped its head up. We saw the debt ceiling debacle. So it seems maybe a little bit of deja vu could be on the horizon if we continue to see concerns in the Eurozone, and as I think Tom or Jeff mentioned, coming up here in May, we're going to be having another discussion on the debt ceiling. It seems at this point the confidence is really going to be whether there's no news. It's almost no news or bad news. And so I think if we kind of remain on this trajectory where things are somewhat manageable and there's no big events out there, investors will continue to go towards equity. I think that they've been really sitting on the sidelines for too long now, and especially seen when you look at the performance of the equity market since the financial crisis, and a lot of investors I think really have missed out on that. So I don't think they really want to put themselves in a position to do that again. So let's go to some of the questions. Real quick, there was a question: is there any seasonality to flows, particularly in March or April, for muni funds being used by taxpayers to pay taxes? Truthfully, we haven't looked specifically at the seasonality of flows when it comes to muni funds in general, it's something we can look at and maybe come back to you with. We did look at seasonality last quarter when it came to equity ETFs for December. We did see that even on a seasonally adjusted basis, investors were really putting much more money into equity ETFs towards the end of the year. But as it comes to the end of March and when it comes to muni funds, to me at least at this point, just off the top of my head, we really haven't seen much seasonality. But again, we can look into that a little bit more for you. Are there any other questions out there?
Okay, well, we're sorry for going over. We're 5 minutes over our allotted time, and usually we try to build in a 5-minute push so we can get questions in as well. We'll certainly stick around if anybody has any other questions. Obviously, getting a little bit of late start here, winter storm, and trying to make sure everybody got on certainly was important for us. So we, probably started about 8-10 minutes late as well. But if you have any questions, please do send them through. If not, we look forward to having you guys show up to our next presentation. It'll be on Tuesday, July 9th. We'll have the same presentation. And by the way, if you have a colleague that would like to listen to the playback, again, I hope to have it posted by Thursday. And of course, for everybody who registered today, I will be sending out the PDF version of this WebEx presentation. And if you guys have not had an opportunity, I would encourage you to go to lipperinsight.thomsonreuters.com and take a look at it. We've got weekly information coming out both on flows and interest articles, and I think you'll find that a useful site.